Good morning, ladies and gentlemen. Great to have you all back again online for Boutiques on Wednesdays. Today we will look at equities and fixed income, but with a bit of a twist. By now, all of you know about different investment styles in the equity market. We know value, growth, and quality as it dominates the asset management landscape. And yes, there are style agnostic fund managers. But the one investment style I think often missed or overlooked is market or price momentum. Perhaps because there are very few momentum as a style fund or fund managers in SA, and more so at reasonable fees. But what is momentum investing all about, and can it generate alpha in bull and bear markets? Then we're also going to look at SA or fixed income. We know that credit are among the various investment instruments or drivers of returns. Locally and globally, credit proved to be a good diversifier in client portfolios over the past decade or more than a decade, especially when bond yields are volatile. But with spreads contracting globally, clients are asking, is this still a viable option, or should I still include this in client portfolios? With that said, it's my great privilege to welcome two fantastic fund managers this morning. On equities, we have Charles from Methodical, and on fixed income, or more specifically credit, we've got Louis from Fairtree. Good morning, Charles and Louis. How are you doing this morning?
Morning. All good.
Morning,
Thank you.
Eugene.
Thanks, Eugene.
Fantastic. Thank you so much for joining us this morning. Looking forward to this. Interesting times indeed. Charles, you up first, so you can start sharing if you're ready. For our audience, Charles will be followed by Louis. You know the story by now. Q&A bubble. If you have any questions, please post it, and we will cover as much as we can after both presentations.
Yeah, thank you very much, Eugene. Morning, everyone. Let me just quickly share my screen here. Share. Okay.
Yeah, it's coming through. Perfect.
Cool.
Thanks,
morning,
Charles.
everyone. As Eugene mentioned, I'm Charles Keert. I'm portfolio manager of the Methodical BCI Equity Fund and the Methodical BCI Global Dynamic Fund. Both are systematic quantitative funds. A little bit of agenda that we'll cover today. We'll cover the business, a little bit of background about Methodical, update for Methodical, and our journey that brought us where we are today, performance of the Methodical BCI Equity Fund, and the investment philosophy, process, and outcome underpinning this fund, and then a conclusion, why this fund would make a good addition to any fund of funds or multi-managed funds. A little bit of background about Methodical. We were established in 2016 by Eddie Bresiker and Ross Roovers. We're an independent specialist boutique asset manager. We are wholly owned by management and employees. We are all shareholders and invest alongside our clients. That brings our interest in alignment with that of our clients. We offer a broad range of unit trusts across the risk spectrum. We do follow a siloed approach, meaning we don't have a CIO with a house view that filters through into all our funds. Each manager manages the fund on their own investment approach. That said, our fixed income is managed by JD du Plessis. Equity Preserver is managed by Savon de Priya. And Equity and Global Dynamic managed by myself and Edu. We're a small focus team. We only focus on investment management. Everything else is outsourced. The Methodical BCI Equity Fund was launched on the 1st of June 2016 and just at its 9-year anniversary. We currently manage just under 600 million in the fund and another 600 million in seg mandates following the same strategy. We have a broad client base with no real client concentration risk, and our firm AUM is just over 10 billion rand. So everyone that started a business or a fund or a new technology knows the path to success is unfortunately not a straight line. It goes through cycles. Those of you that have seen this graph before, this is known as the entrepreneurial journey when talking about launching funds, or the Gartner hype cycle when launching a new technology, or the Dunning-Kruger effect when talking about the knowledge or perceived knowledge of a certain field. And this is very applicable to our business and to our equity fund. When we launched our equity fund in June 2016, we had big aspirations. It was one of the first non-smart beta or benchmark agnostic quantitative funds in the country. But we soon realized this was a bit of more of a challenge than we thought it would be. Investors were looking for a longer track record, a larger fund, a more experienced team, a more stable business behind the fund. But we kept on grinding, never changing our investment philosophy, only improving on the implementation thereof. And we feel that we as a business and the fund has reached the plateau of sustainability. The fund has been through various events, Brexit, COVID, Trump, Nenegate, Trump 2.0 so far. And it's proven itself to be a sustainable fund backed by a sustainable business. Looking at performance of the fund, I think when we talk about performance, investors usually expect the capital appreciation line, bottom left, top right. But we feel that doesn't give a true reflection of the average investor experience. We believe that looking at rolling numbers, this graph is showing 5-year annualized rolling numbers. The way to read this graph is our annualized numbers are depicted on the y-axis, while the peer group is depicted on the x-axis. Any dot is a 5-year rolling period, and a dot in the green means we're outperforming, and a dot in the blue means we're underperforming. This shows that we outperform 96% of the time over the rolling 5-year basis. And the 2 periods we didn't outperform the peer group, we were very much in line with the annualized returns. And unfortunately, we can't guarantee future returns, but we can guarantee that the implementation of this process is more robust than it was 9 years ago. So we invest based on a momentum factor, as Eugene mentioned, and everyone will be familiar with all the investment styles depicted in this little puzzle. And the interesting fact about all these styles is they do a very good job at explaining returns after the fact, but they're not the true return driver. What I mean by that is, let's say, for instance, value shares did well last year, or shares with PEs under 12. They didn't do well because the PEs were under 12. The PEs could have been under 12 for many years prior, and they could have underperformed. They started performing because there was a catalyst prompting investors to start buying a sector that was dominated by that factor. And the same holds true for any of the other factors. And that's what makes momentum slightly different. Momentum sits on the sideline and starts waiting for a small trend and takes a small position. If the trend continues, we'll add to that position. If it doesn't, we'll take away and add something else. And that's why we call it the chameleon factor, because it doesn't matter if it's growth, quality, or value trending. We invest in a trending share. If it continues to trend, we'll keep on investing in that sector. So this investment process is based on a scientific discovery called the wisdom of crowds. It was first published by Sir Francis Galton in 1906. He was at a country fair where people had to guess the weight of an ox. There were 787 guesses. And he took all the average of all the guesses, and the average came to 1,197 pounds, only 1 pound off of the actual weight of the ox. And closest as the closest individual guess. And there are countless other examples of the wisdom of crowds. Who Wants to Be a Millionaire is quite a good example where the crowd is right 91% of the time. And quite an interesting one for me is the Challenger disaster in 1986. There were 4 engineering firms involved in designing the rocket. On the day of the crash, 3 of them, the share price of 3 of them fell about 3%, but Morton Thiokol fell 12%. But only after 6 months of investigation did it come out that the O-rings designed by them were actually the culprit of the crash. So again, it shows that the crowd knows more than the individual, and insiders know. So we just follow the trend. We don't make any predictions. As I mentioned, this is the life cycle of a share in our portfolio. We don't wait for a share. We wait for a share to turn. We don't try to pick bottoms or tops. so we're always late to climb into a share and always late to get out of a share. So if a share starts trending high, we'll take a small position. As the trend continues higher, we'll add to that position until the trend turns. We'll start slowly allocating away from that share. And this gives us portfolio convexity. You can put market regimes in three regimes. We want to say a crisis regime, that's long extended downtrends, a chaos regime, which is trendless, choppy markets, and a confident market. What momentum investing gives investors is alpha and confident markets, trending markets, whether it's downtrending crisis markets or uptrending confident markets. It does, however, come at a cost, and they do tend to struggle in chaos, choppy markets. But we know even if the market as a whole is trendless, within the market there will always be sectors trending upwards or downwards. On the right hand side, not to get too technical, this is just depicting our global process. Normalized returns, what I mean by that is up to 12-month returns divided by 12-month risk or 12-month standard deviation. Plotted that on the y-axis and the market returns on the x-axis. And this just shows that the market suffered various 2.5 to 3 standard deviation down periods, while our strategy was kept at only 2 standard deviations. While we had unlimited upside, market again was kept at 3 standard deviations up. We had a few 4, 5, even 6 standard deviation up moves. And this proves people think in momentum investing is very volatile. Yes, it is, but it's not downside volatility. It's not more risky. It's upside volatility, and it's good volatility. Another way to visualize this is in a distribution graph. If you were to put all stock returns in a distribution graph, you would see that stock returns have fat tails. What I mean by that is a stock that went down 90% today can go down 90% tomorrow, 90% the day after that. And the same on the other side. Stock that doubled last week can double again this week and can double again the week after. So what you want in a strategy is a strategy that avoids those left tails, avoid the permanent loss of capital, without the cost of giving away upside on the right-hand tails. You want to participate in the right-hand tails. And looking at the attribution per share the past 5 years of the methodical equity fund, you can see that's exactly what we did. We had numerous small losses, all capped at below 1%, while we had a few big winners, 3, 4, 5%. Again, participating in the upside while capping the downside. So in conclusion, we're a stable business. We own by management employees, and we have no client concentration risk. Eddie and I don't see ourselves as risk as portfolio managers. We don't go and chat to management. We don't have a macro view. We see ourselves as risk managers, managing the risk inherent to the process. And we've been managing this portfolio since portfolio inception. We believe that a momentum-based investment approach delivers portfolio convexity and alpha through the cycles. And we have an excellent long-term track record that proves this. Quantitative approach removes all biases, and it's repeatable and scalable. The process that we run for our local fund is exactly the same philosophy and process that we run on our global dynamic fund. And we believe that price momentum is a permanent feature of equity markets, and there will always be changes in economic cycles, in technology and risk environments. And investors' response to those changes will create trends in markets. And Eugene, that is my story. Thank you very much. It's short and sweet.
Joel, thank you very much. You can stop sharing, then Louis can come on and he can share from his side.
Morning. Okay, my name is Louis. I'm co-manager of the Fairtree BCI Income Plus Fund, and I'm going to talk to you about this share here. There we go. Talk to you about its performance and its prospects. Okay, so because it's a credit fund, I'll talk to you a bit about credit markets. I'll tell you about what risks are in the fund, the performance, and what you can expect from the fund going forward. Now, When I talk about credit markets, I'm going to talk to you about European high yield credit markets. There's 33% of this fund is invested in high yield hard currency markets. There's not a lot to say about the domestic market. Spreads remain relatively tight. There's not a hell of a lot of issuance given the tepid growth. So if we have a look at, this is a European high yield credit index. It's the iTraxx crossover total return index. It's an index of the 75 most liquid European sub-investment grade corporate names, all equally weighted. It's a total return index, so it's net of all credit losses. And you can see that the past year has been a pretty good year for credit. This index has delivered 7.3% in euros, which is more than 4.25% above returns from 3-month Euribor. Now, in April, it had a bit of a drawdown of 4.22%. Reason for that was that was Donald Trump's Liberation Day and the introduction of tariffs on the US trading partners. We saw quite a sharp spike in credit spreads globally, but it came back pretty quickly. And as I say, 33% of this fund's assets are in similar sort of high yield European or US assets. But it's easy to see why credits performed so well. If we have a look at the same index, but in this case, it's the unfunded index. So these are essentially credit spreads over Euribor. You can see that credit spreads been, for the last year and a half, been very well contained around that sort of 300 basis point level, except for this recent spike that we saw in April. And we did take advantage of the spike to add a little bit of hard currency exposure to the fund. Now, this index, iTraxx crossover, it's a 5-year index, so it's got a spread duration of about 4.3 years. So you can see that basically sort of 100-point spike in credit spreads would generate that 4.22% drawdown. But as you can see, it's come back pretty quickly. And there's good reason it's come back, and that credit spreads have remained contained. If we look at the default experience, we have a look at this chart along the bottom. The orange bars are monthly defaults or credit events. So these are basically defaults by bond issuers. So this is Chapter 11, bankruptcies, or any sort of a restructure by bond issuers to the detriment of bondholders. And then in blue, we've got the ECB main refinance rate. In green is the federal funds target rate. You can see no correlation between policy rates and default rates. And if we look more recently, we had this very steep and coordinated rise in policy rates beginning at the beginning of 2022, and we didn't see any uptick in defaults at all. In fact, they've been quite muted and below their sort of long-term averages. Last year, there were only 3 defaults. This year, there have been none. And the 3 last year, we were exposed to all 3 of them via indices. But to give you some idea, of the extent, I mean, the credit losses taken by this fund over all 3 of those defaults amounted to 14 basis points of performance. Now, consider that that's from an index generating 300 basis points plus per annum. It's really not meaningful at all. In fact, even if we have a look at all of the defaults that have occurred since the end of 2020, of which have been 19, only 7 have been corporate names and we've been exposed to all of them and taken credit losses from all of them. The rest have been a Chinese company and a couple of Chinese companies and a couple of sovereigns. We have a look at iTraxx crossover series. So iTraxx crossover started in March of 2004 with an initial 30 equally weighted names. It was series 1. These indices are 5-year. They're 5-year indices, and they're reconstituted every 6 months into a new index. So S1, S2, S3, all the way up to S32 have all matured. S33 matures in December, S34 in June next year. And then we have a look at the default experience over the 5-year life of the series. And these are the orange bars along the bottom. You can see that it's been quite muted if we look at all the way up to S32. If we then adjusted for recoveries on the defaulted names, we can see that it's lower still. So credit has been a profitable place to be invested. If you're in this fund, it's not going to be risk-free. It is a low volatility fund, but it does carry risk. Obviously, default risk is the most obvious one. If you invested in this fund, you're going to take credit losses. It's inevitable, but we can mitigate this pretty easily through portfolio construction and diversifying the portfolio as much as possible with as many uncorrelated assets as we can find, and also sizing positions correctly. So if you're in this fund, you can expect to suffer a continuous default rate, but obviously, the theory is that, net of all these credit losses, you're still being overcompensated for the credit risk you're taking. And if you look at the previous slides, you can see that has been the case. The fund has hard currency assets, but we hedge all the FX out of it, so there's no risk from the currency. It also doesn't have any modified duration or interest rate risk in the fund, which is a bit unfortunate at the moment, because if you look at the All Bond Total Return Index, it's generated over the last year sort of 21.5% return, which we unfortunately haven't benefited from at all, which a number of our competitors have. But that's not our game. This is a credit fund, a pure credit fund. And the reason it doesn't have any interest rate exposure is that it's a portfolio of floating rate notes. So the coupons move up and down with prevailing rates. If you buy a bond, you own a series of fixed cash flows, and you're valuing that bond by discounting those cash flows at prevailing term rates. Now, if those term rates increase, your discount rates increasing, the present value of those fixed coupons is low, and your bond trades at a discount. With a floating rate note, you've got this floating coupon. So your expected coupons are increasing or decreasing at the same rate as your discount rate. However, your floating coupon is made up of two parts. There's a floating part, which in our case would be JIBAR, and then we get a fixed credit spread that we're earning on top of that. And that credit spread is fixed at issue of that note. Now, as long as the credit spread demanded by the market is the same as the contractual credit spread on your note, your note will remain at par no matter what interest rates do. If the market, however, decides that it requires a wider spread than the contractual spread of the note, your discount rate is then increasing quicker than your expected coupons are increasing, and your note will trade below par. So two very similar measures: modified duration sensitivity to interest rates, spread duration sensitivity to credit spreads, and this fund is exposed to the latter, to spread duration. So movement in credit spreads, as we saw in April, has an effect on the fund, although that came back pretty quickly. And in 2022, where we saw quite a large increase in credit spreads, we saw a couple of small negative months from the fund. Although for the year as a whole, it still outperformed STEFI and bonds and equity, nonetheless. So what's performance been like? This is a total return chart of the long-term performance of the Fairtree BCI Income Plus Fund, indexed to 100 inception on the 1st of April 2014. So it's 11 years of data, long time period. It's generated 9.1% per annum. So BCI Income Plus Fund has given you 164.54% over the period, top 40, 189.66%. Albi 160.55%, and STEFI 105.81% over the period. So just having a look, Fairtree BCI Income Plus is the orange line. You can see it much less volatile than the other two. If we look at, even though they've all three of them ended up, reasonably close together here, they've arrived there with very, very different volatility. If we look at volatility of Income Plus, standard deviation of annualized standard deviation of monthly returns, Income Plus only 1.71%, bonds 8.12%, and equities 14.55%. So much less volatile. Does have periods where you'll see a bit of volatility, as you saw in 2020 and 2022, but it comes back reasonably quickly. We then have a look at calendar year returns. 2024 was a good year, 11.34%. Didn't quite meet the, we target STEFI plus 3%, 2.6%, but that came on the back of 465 basis points over STEFI in 2023. And if we look at absolute terms, STEFI plus 2.6%, still 8% over inflation. So it's been a good place to be in income funds. And in this year, chugging along a pretty normal year. This is to the end of May. So on track this year as well. But probably the most powerful reason, apart from the good risk-adjusted returns from the fund, is the fact that it's not correlated to other asset classes. If we have a look at the correlation of this fund to equities using the top 40 total return, 0.34, and to bonds using the All-B total return, only 0.4. So that's a compelling argument to have it in broader portfolios. This is the ranking of the fund. It's in the category, the multi-asset income category. If you have a look, it's got very good long-term performance. Over 10 years, it's generated 9.08%. It's placed in 1 out of 52 funds in the category. Over 5 years, 5 out of 97. 4 years, 5 out of 105. 3 years, 2nd out of 112. 2 years, 19 out of 120. And if you look at this year, 10.48% is a pretty good return from an income fund, but it was only enough to place this fund 109 out of 139 funds in the category. Reason for this being is the performance of bonds. So the All Bond Total Return Index over the last year has generated sort of around 21.5%. We haven't benefited from that at all, whereas funds that have had exposure to modified duration have obviously benefited from that. But yeah, again, that's not our game. Credit's our game. This is a more sort of a tortoise than a hare type of strategy. On the right-hand side, standard deviation, you can see over all periods, very low standard deviation. So where to from here? So, I mean, personally, I think trying to forecast things is a bit of a waste of time. But what we do know, we know what components generate returns in this fund. And then what we can do is we can take those components and see what the market's expectation of those components will be over the next year to get an idea of what's possible. So the main component are short-term rates. So in our case, it'll be JIBAR. Have a look at that. Then we have the spread, the weighted average spread that we're able to earn on the fund currently. Then we can factor in a bit for credit loss that'll detract from performance, and then spread movement that may add or detract from performance, so we can ignore that. So if we look at the first component, the JIBAR component, this is a 1-year swap rate. It's currently sitting at 7.08. It's showing you that, and this is derived from the market's expectations of where short rates will be over the next year. So this is what the market expects 3-month JIBAR to do over the next year. It's expecting rates to decline further by another sort of 40 basis points. If we look at the individual components, so these are from forward rate agreements that trade in the market. We know 3-month JIBAR today, or yesterday at least, was 7.325. Market is expecting 3-month JIBAR in 3 months' time to be 7.095. 3-month JIBAR in 6 months' time expected to be 6.97. 3-month JIBAR starting in 9 months' time, 6.93. So you can see market participants expecting rates to decline by another short rates to decline by another 40 basis points, and for JIBAR to bottom out in this cycle in the low sort of 690s over the next 9 to 12 months. So rates expected to come down a bit further. Now, if we then the next component, spreads. So domestic spreads, I mentioned earlier, very tight, but domestically, but offshore, if you look at this is the chart I showed you earlier of the iTraxx crossover. Spread's still generating decent spread for us offshore, 300 basis points. So that allows us to maintain a decent weighted average spread on the fund. Currently, it's about 240 or 245 basis points. So if we add these together, we take that 1 year that 1 year swap rate at 7 or 8, and we added 240 basis points, takes us to sort of 9.5%. If we make allowance for some credit losses there, wouldn't be unreasonable to expect the fund to generate between 9 and 9.5%. So, which is still a good year. I mean, it's not going to match what we did in 2024, which is it's very unlikely to do that in an environment of declining interest rates, but nonetheless, still a good return. And of course, all this assumes that the market is correct in its assumptions about where short-term rates are going to be over the next year. But that's what we have, and we're still pretty positive. Thank you, Eugene. That's
Louis, thank you very much for that. And I mean, the one graph that you showed there with low correlations is exactly that. You've explained how the fund is not sensitive to interest rate movements or duration, because there's no duration in the fund. It's all floating rate notes. It works very well when there are volatility on bond yields, and we've seen it a couple of times in 2024 and 2023. If bond yields move up, it is really no impact in the fund. Maybe to start with a question from the audience, and it refers to one of the slides you also showed on credit defaults. And the audience member said, it appears that if defaults tend to increase as rates start to come down or as the economy weakens, with rates going down at the moment, does the historic indicator show that we will see more defaults?
No, it's actually, it does appear that way on the chart, but generally what happens is that there's a lag. So if you have a look, it appears that in 2008 you had sharp cuts in interest rates almost to zero rates, and then you saw this big spike in defaults. But actually what happened was the crisis was here already, and the rates were cut, and there's a little bit of a lag before the defaults come through. So the cutting cycle we're seeing now has not been in response to any sort of crisis. It's been in response to slowing inflation. I mean, the rises were due to a lot of upside surprise in inflation. Those have come off, and that's why interest rates are slowly trending down now.
And I mean, you and Paul showed how many times there's always defaults. It's how you manage the defaults, having a good spread in the portfolio. Let's talk a little bit more about credit. And I mean, we've heard comments right through the year, especially on the SA credit side. Spreads has come in. You're not really, or opinion is that you're not really getting rewarded for taking on credit risk in SA. I mean, some of the banks, the yields are trading below SA nominal bonds. What is the case for SA credit?
Well, you could argue that they should be here because there's still demand for the paper, and there haven't been any defaults. So yeah, I mean, you are being compensated. There is a bit of crowding out from the sovereign. I mean, we've in the past haven't had a lot of government exposure, but recently we've been putting a bit of the government floaters in here as well, because as you say, we're getting 135, 140 basis points, which is quite attractive compared to what you're getting from some corporate names.
If you look at global credit, moving on global, you've explained the global component in the fund where the currency is hedged out. We all know that by now. But again, if you look at asset allocation modeling from a lot of strategic asset allocation partners, big red block when it comes to global credit. And I do understand that argument when it comes to US credit, because again, the spreads are very thin to non-existing. But you focus more on European credit. Maybe just explain to us how the European credit differs from US credit.
Look, we do have exposure to US credit. Our exposure is dominated by European credit because we've been involved in those indices for quite a long time. So we, since the inception of these indices, but we do have some as a diversifier, some US credit. It generally pays a little bit more than a European credit, probably on a CDX. I don't know where it is right at the moment, but it's probably 50 basis points higher than crossover. But experience has been that even though we earn a bit more spread from it, we found that default rates tend to be a little bit higher in the US because it's very easy to go into Chapter 11 and exit Chapter 11 again, and debt holders are written off, and recovery rates also have tended to be lower in the US than in Europe. So we have a bit of a bias to Europe, but they're pretty similar. I mean, the spreads we're earning in the US and Europe are comparable.
Bit of a tricky question. Some of us run global portfolios as well, and if we want a bit of a buffer, we look at either US treasuries or then global credit. You've got the global credit fund as well. There is a rand feeder, but the currency is not hedged. If you've explained the positioning of your global, so that's the pure global version. But just in a nutshell, we know that the dollar is under pressure. You mainly invest in European credit, but from an SA investor perspective, how will currency movements potentially impact the global income plus?
Oh no, it has a huge impact on it, because you've got you've got the currency exposure, which can be a big kicker. You need to look at the global income plus fund, against its benchmark, which is that iTraxx crossover total return index, and it's done really well against that index. You can't look at the BCI Global Income Plus feeder fund and compare that, because that's got the currency. So you need to look, if you want to make a call on the performance of the global fund, look at it in euros, and then decide whether you want the currency exposure or not.
Yeah, I mean, the euro is still holding value. So
Yes.
I think from that perspective, it makes a lot more sense. Louis, I just want to step off the credit conversation for now. And Charles, just maybe if we look at the Methodical BCI equity fund, you've explained momentum to us to some extent. But just let's just try to unpack that a little bit more in plain English. So when it comes to the stocks that you hold in the portfolio, how do you get to the stocks that you hold and the weightings of the stocks that you hold in the portfolio?
Yeah, Eugene, it's a fairly actively traded strategy. And as everyone knows, our local market isn't that liquid anymore. So we focus on the top 60 most liquid shares. And if there's a trend showing at 3 months, we'll add a little bit. 4 months, we add a little bit more, all the way to 12 months. So it's all relative. If all the shares are going down, we'll buy the shares that goes down the least. If everything's going up, we'll buy the shares that go up the most. And weightings are determined on how strong that trend is, or how persistent that trend is. So if it's showing a trend at 3 months, 4 months, 5 up to 12 months, we'll have a big position. If it's only showing a trend on maybe 3 months, it will have a small position. As I said, we're waiting for that confirmation of the trend, and as it strengthens, we'll add and add and add to the position, and as it weakens relative to the rest, we'll take away.
One of your topics that you sent through as well, that momentum can actually generate alpha in bull and bear markets. Again, just to unpack that concept for me, because if at quick glance you think momentum can only do well in bull markets, so tracking price momentum or market momentum. But you're saying alpha and bear markets as well. Why is that?
Yeah, Eugene, I think if you think about the mechanics behind momentum investing or trend following, is you're buying shares that's going up or that goes down the least. So if everything's going down, you're buying the stronger shares. You're buying your utilities or defensive British American tobaccos locally that goes down the least. And there's also asset classes that's uncorrelated to the market. If equities go down, gold has proven to be a good edge. When equities go down, we don't go to cash, but even cash on an absolute basis, if equities experience extended downward market, like the subprime price of 2008 or tech bubble 2098, moving to other asset class can provide you with the edge. So, and I think it's because it's a fairly actively traded strategy. You move out of falling assets quite quickly into more stronger trending assets.
We've seen some other momentum trading funds with exuberant fees, because we know, being a momentum fund, there is active trading, exactly what you explained now. How do you manage fees or trading costs in the fund?
Yeah, Eugene, I think one thing to mention, all the performance I showed on the slides is for our most expensive retail class. We don't share in any brokerage. We trade fairly cheaply. Yes, transaction costs will be higher, but that's the cost of doing business. I think when I said we improved implementation over the course of the past 9 years, I think that was the main focus, is reducing trading costs, is to not, to see how long can we hold a share before we have to sell out. So unfortunately, it is a strategy with a higher turnover, but we can have lower trading costs, but it will come at giving away returns.
I totally understand that. I think the point rather is that, compared to some other momentum funds, your fees are still reasonable, but that explains that. Let's just quickly look at your asset allocation. You've got a global equity component in the fund as well. How does that work? I mean, you screen the whole universe. Do you look at most liquid stocks in the US, or how do you populate that space?
I think that's what makes a quantitative or rules-based strategy quite practical. We can scan quite a large universe. Currently, because of fund size and the liquidity and trading cost in the US, we only scan for the US. We scan the Russell 3000, the most liquid shares in the Russell 3000. So it gives us quite a big universe. We do run a seg mandate as well, where we allocate based on MSCI world weights, and we just buy ETF by tracking MSCI ex-US for the 30% that's not the US. But for now, I think looking at the US, there are shares that isn't the Magnificent Seven that's doing extremely well. And for now, that universe more than big enough, we feel, to produce some alpha.
And sticking to the momentum strategy, how do you manage your onshore, offshore asset allocation model? So when you decide how much you've got an SA equity and offshore equity, and what are those weights currently, more or less?
Currently, we're running about 65 local, 35 global. We did bring it up to 30% when CISA limits moved to 30%. We didn't move it to 45 when they adjusted to 45. We do run a PPP model against the dollar, but that's more of a indicator for new cash. So if new cash comes in and the rand is cheap, we'll stay local. Otherwise, we'll move to global. But for now, we just let it drift. So we'll let it drift if, again, because we believe in momentum, if there's more momentum in global shares, we'll let that allocation drift all the way up to 45%. If the rand blows out to 19 or 20, and there's new cash coming in, we won't take it offshore. If the rand strengthens to 12, we will definitely take some more offshore if we're not at the 45% limit yet.
I think that 12 is going to stick in our heads now. Charles said the rand's going to 12. No.
Definitely not.
Charles, no, I know it's by way of example. Question from the audience: what is your active risk, and how benchmark cognizant are you?
We are totally benchmark agnostic. We don't even look at market caps. We only screen for liquidity. And our tracking error is at about 10%. So it is on the higher end, but we believe to generate alpha, you have to look different to the benchmark. And it makes us a good diversifier as well. I think if you look at correlations, we have some of the lowest correlation to other fund managers and the market in our whole local market. So it's a good diversifier for a fund of funds.
Another question from the audience, and it speaks to your global dynamic fund. If we can take a question on that. I know we focused on the Methodical BCI equity fund, but let's just see. Please explain your position size in the local equity and this decision process on that determines the asset allocation in Global Dynamic Fund. I'm not sure how involved you are with that fund. Maybe a bit of
I'm
unfair question.
100%
But let's see.
involved, Gene. I think so. I can the position in the equity fund is 20%. That's based on a CISA limits, and it runs exactly the same process as we run locally. We scan the Russell 3000, as I mentioned, for liquidity, and we scan for the top 400 most liquid shares. And position sizing, again, it's based on momentum. If there's a strong trend in a share, we'll buy more. If there's a weak trend or only a trend on a few look back periods, it's a smaller position. I think what sometimes confuses investors, if you look at our MDDs, is the classification of some of the assets we use. We do trade futures, that's classified as cash. We do trade GLD or New Gold ETF, that's classified as a bond. So sometimes when investors look at our MDDs, they get a bit confused, but both the Methodical Global Dynamic and our equity fund runs at about 99% equity allocation.
When would I use Global Dynamic? Would I use it in the portfolio when I want to get explicitly more global exposure? And does that also follow predominantly your momentum investment style?
Exactly. It follows exactly the same philosophy, and implementation is 100% the same. It's just the universe is different. It's classified as a global multi-asset flexible, but we run it as a global equity fund. So if you want exposure to global equities, that's a good building block. And as I mentioned, we only look at the US for liquidity and trading cost purposes. But if you believe in the fund, you can just add a 30% or 28% allocation to MECI ex-US ETF, like we currently do for one of the seg mandates we run.
Very interesting. Last question to you, Louis. I think to take part of this question, how many opportunities are you seeing in European credit at the moment? My understanding is that spreads are generally quite tight there as well.
Well, look, it's an unlimited universe. There's so many. We tend to play in those indices. So, we see plenty of opportunity there. The thing that restricts us is more, so we're obviously limited to 45% of the fund in offshore assets. But then this sort of level, the sort of 33% level, if your offshore exposure gets too big, because we hedge all of the currency out, you've got to maintain a lot of liquidity domestically, which is obviously another drag on performance, to cater to the currency hedges. So, you could move it to 100%, but then you'd obviously, would have some issues with the hedges. But there's as you've seen, from the default rates at 300 basis points, it's a bit of a gimme as far as we're concerned.
I would encourage the audience to go look at the Global Income Plus as well and the performance that you've generated there, although we didn't cover it this morning, but very interesting and also very low correlation to other fixed income or asset classes. And maybe to conclude with that, both funds on the equity side, momentum is investment style, good diversifier in portfolios, as well as credit, all the global credit side in client portfolios, and there's good reasoning behind it to include in any client portfolio. Gentlemen, I want to thank you for your time this morning. The clock caught up with us. It's been very insightful indeed. To our audience, you know how it works. If you want to have a further discussion on Methodical or credit with Fairtree, please get hold of us or their sales teams or Charles or Louis directly, and you can have those discussions. Thank you so much for our audience for joining this morning. Charles, Louis, we'll chat to you again in the very near future, and we'll see you in the streets and with our clients. Always good to have you on board. Thank you so much.
Thank you very much.
Thank you, Eugene. Thanks. Bye.
Quick reminder to our audience, next week, Wednesday, we're going to continue our discussions, boutiques on Wednesdays as per usual, starting at 8:30. Looking forward and seeing you again next week, the 11th of June. Thank you so much.